fellow risk takers. This is your worst podcast host, Andrew Stotz from A Stotz Academy, continuing my discussion with Larry Swedroe, who for three decades was a head of research at Buckingham Wealth Partners. You can learn more about his story in episode 645. Larry stands out because he bridges both the academic research world and practical investing. Today, we're diving into a chapter from his recent book, Enrich Your Future, The Keys to Successful Investing. And that chapter is chapter 24. Why, and Larry, come on, why do smart people do dumb things? Take it away, Larry.
Yeah, it's a really challenging question. And we all know people, and probably including ourselves, who have done some dumb things. I recently had, my best friend, uh, he had to fix something on the ceiling that was right at the top of a staircase. And the dummy gets on a step ladder, climbs up and slips, goes down the stairs crashing. Miracle, he only broke his shoulder, didn't snap his neck and die. And the guy's was a multimillionaire. He could have hired somebody for $100 to fix the thing, but no, he has to get on a step ladder at the top of a staircase. We do dumb things, right? Especially probably for us men when we were teenagers and, probably took risks we shouldn't take. So we all know that this to be the case. But when it comes to more important issues, maybe, and when there's science and knowledge, hopefully we can avoid them. For example, I think certainly in the US especially, the amount of people who are smoking today has gone way down because of the warnings that say from the Surgeon General, smoking is hazardous to your death. You're likely to get cancer. Not everybody stops smoking, but most of the people, clearly the vast majority, do that. What's really interesting about this analogy is when it comes to investing, the SEC does provide some guidance. And on all advertisements for mutual funds, if you're an actively managed fund, of course, it has to carry the warning that past performance is not a predictor of future performance. Now, you would think that investors would heed that warning, but all of the evidence shows that investors' money flows into the funds that have had the most recent best returns and flows out of the funds with the recent poor returns. One psychologist said, the problem is it's not descriptive enough. And what the SEC warning should say more explicitly is specifically past outperformance has no predictive value as to future outperformance. That might make a difference. Maybe. I'm not sure that's the
Yeah, and
case.
when I read what you wrote about it, and then I looked at the research and their recommendation, I was like, I don't know if that's tough enough, and but you can't say past performance will not repeat,
Yeah.
because it could.
Right, absolutely. But here's the thing about we talk about smart people doing dumb things. Uh, Here you have the average retail investor. You could excuse maybe their behavior because they're ignorant. I don't mean it in a pejorative sense, like being dumb. I mean, I'm intelligent, at least I think so. I graduated at the top of my class in one of the better MBA programs in the United States, but I'm totally ignorant about nuclear physics. And my wife and three daughters tell me women is another subject that I'm ignorant in. All right. So unless you get an MBA in finance today, you probably haven't taken a single course in capital markets theory. So where do you get your advice from Barron's and CNN? And they're going to tout, active managers because they need your attention to sell their ads and all that stuff.
Hmm.
Okay. But you would think the big pension plans in the United States will hire world-class consultants who certainly have the knowledge about the academic research. You would think that the people who are on the board and charged with math should be at least aware of the academic research, just doing their due diligence to do their jobs. And yet, here's what the evidence shows on every study done on the performance of pension plans. They hire consultants. They measure performance based on like typically 3-year periods, some cases maybe 5. When all the evidence says that's way too short a period, it's noise, irrelevant, but they do it every 3 years or so. And the managers they hire to replace the underperformers, they go on average to underperform. And the managers they fired go on to outperform, which means they would have been far better off doing nothing, let alone incurring all the trading costs that are implied when manager A comes in to replace B and they don't like the stocks they're holding. So you got a lot of trading going on. And yet they keep repeating this. Now, I've had to present at pension plans trying to get their business by using more systematic, transparent, and replicable funds like or similar to index funds. Okay. And I asked them, I said, how has that worked out? Why do you keep hiring new managers? I'm telling you that something must have gone wrong in your process because it didn't work. So I ask you, tell me what you're doing differently this time in choosing the managers that will prevent you from making the same mistake. And you know what the answer I've gotten every single case is? Nothing. Never once got an answer.
Why?
It's unbelievable. They think they're going to get some different outcome repeating the same dumb behavior. It's amazing. So there's really no good explanation except human stupidity. And there's only 2 things that are infinite: the universe and man's capacity for stupidity.
Now, in this chapter, you highlight some great research that talks about what's happening with returns. And I mean, it's so perfectly clear when analyzed, about the top performer, the prior top performers versus the prior worst performers. And now one of the questions I had, but I thought we should go through that just a little bit so someone understands that gap between it. Like you talk about the CAPM alpha on page 145 and
go right ahead and cite the.
So let's just look at this. What this talked about is so let's say the average benchmark adjusted return for the median strategy beat that of the winner strategy by 1.32 percentage points. And the loser strategy, meaning buying the losing funds, outperformed the median strategy, buying the average fund, let's say, by about 1 percentage point. And so the loser strategy, buying the loser or the underperformers, the prior losers, outperformed the winner strategy by 2.28 percentage points.
Yeah.
And what you talk about is, okay, well, maybe that's just has to do with the volatility that they're exposed to. But no, when you do a Sharpe ratio and try to bring in the volatility, you find that the ratio of the median strategy was 0.42 versus 0.25 for the winner strategy, while the prior loser strategy produced a Sharpe ratio of 0.48, higher, meaning better, than the other 2. So the investors.
There's a simple explanation that people say, how could that be? Winners strategies tend to be ones that have performed obviously well in the recent past. So valuations have gone up, meaning future expected returns are now lower. And loser strategies, the reverse is true. That's why value stocks have outperformed over the long term. That's really a prior loser strategy. And the same thing is true, by the way, in commodities. AQR runs a strategy based on long-term returns to commodities. And they look at 5-year cycles. They buy the 5-year losers and short the 5-year winners, because what happens is, right, your returns are poor. That means commodity prices were down. So what happens? The mines get shut down, capacity shrinks, and then you have a problem. So prices go up, and the reverse is true. And when prices go up, new mines open up, capacity increases, and you get a reversal. So,
Yeah,
The
and that,
same logic applies when you get outperformance, whether it's individual stocks or an asset class or any particular strategy that's chasing recent performance.
yeah, and I think that when you're talking about like a capital intensive industry like mining as an example, or oil production or something like that, you just have this natural long-term cycle before they can deploy those assets that they decide, okay, we're going to expand. It could be 5 years before there's any revenue coming out of that expansion. And so it's just a natural like cycle to get. But what I wanted to
The
ask when I
same
was,
thing in agricultural prices, right?
yep. Yeah, so like coffee prices went through the roof, and that hurt our coffee business as we were buying coffee, raw coffee, green coffee that was, just going up in price constantly. But in theory, that should drive the farmers to be much more aggressive at making sure that they're getting the most out of their current plants and planting more. But it doesn't
Planning
takes
more.
three it takes 3 to 5 years before a sapling becomes a bean producing. And
Right.
so we end up 3 to 5 years from now, we could have a glut of coffee.
It's possible. Now, of course, climate and other things can impact that.
Yeah. Now let me ask you a question because um, Carhart's model brought in a fourth factor to the three-factor model originally of Fama French. And that model was that factor was momentum. And
Yeah.
he showed that there was value, uh there was performance
Explanatory
in,
power.
yeah, yeah, explanatory power. So how does momentum is ultimately buying current winners. So how does that jive here with the
Right.
opposite of saying, buying current underperformers?
Well, you have to remember, very importantly, momentum, number one, is a very short-term tool.
Okay.
It is short-term positive momentum and long-term reversion to mean. You get a reversal, okay, because things can't grow to the sky.
Mm.
So that's why you get some persistence in like 1 year, right? Because things are going up. So maybe another, on average, momentum works, call it 4 to 5, 6 months, right? Sometimes it works a year or longer, sometimes only a few months, but on average, it's somewhere around that. So often, a fund that won 1 year might win one more year, but generally, then over the longer term, you get that reversion because prices get too high. So the problem with that is it looks great on paper, but when you have very short-term factors like momentum, what happens to your turnover? Because to capture it, you have to trade frequently. So you easily can have over 100% turnover in momentum strategies, which especially, and momentum is most powerful in the illiquid stocks like smaller caps. And there your trading costs are much higher. So momentum can be very tricky to implement.
So
And it may not survive transaction. You have to know how to manage your trading course well, or I would not try to run a momentum strategy.
and I'm
Uh,
assuming that the funds or the ETFs that are done by, I don't know, Dimensional or AQR that are trying to take advantage to some extent of momentum, they just have such a competitive advantage in the trading costs.
but let me give you an example of how Dimensional uses it that actually reduces turnover. All right, which sounds contrary to our prior discussion. So Dimensional used to ignore momentum because Fama said it's BS,
Yep.
it doesn't exist, it's phony, it's in the charts. And then finally, I think Ken French convinced them the data was so overwhelming, they shouldn't ignore it. Okay. But what they did do is this. Let's say DFA would buy the stocks in the bottom 20% of PE ratios to
Mm.
keep it. Now, a stock, how do most stocks get to be value? They were once growth stocks and the stocks do poorly and they're going down. Once it got to that bottom 20%, then DFA would buy it.
Mm.
Okay.
Okay, so let's just clarify. What you're talking about is kind of a derating where a stock's share price is falling down because the fundamentals have slowed down or something like that. So the market's no longer valuing that stock at, let's say, 25 times. It's now all of a sudden derated to be 15 or 10
Or
times.
12 or
Yeah.
whatever the break point is. Let's say 12 is the break point to buy. So now it goes down to a PE below 12, and DFA prior to I think 2003 would have bought it. They changed that to say it will go on our eligible list, but it's suspended. We won't buy it until the negative momentum stops. So what does that do to your turnover? It lowers it because you delay the trade. On the other side, how do value stocks deliver outperformance? They become growth stocks. Their PEs rise as their profitability tends to revert to the mean. Okay. And they get a turnaround. So the PE may have been 8 and now it's 12 and a half, and now they would sell it. David says, no, we won't sell it. We'll put it in our eligible to sell list, but we won't make it a priority to sell unless the momentum turns negative. So it'll be on the list, but it's not the highest priority in our algorithm to sell it. So that delays the sale. So they have a buy and even a hold range. Well, we won't buy it. We won't sell it when it gets above 12 till it gets above 14, and then we'll sell it.
Mm.
So created
So,
these buy and hold ranges. So that's incorporating momentum without specifically trading on a signal to buy or sell. So
yeah,
that's one way you could do it.
it's like creating buffer zones or
Yeah,
places where you don't act, but it's getting closer to act. Interesting.
right. So what that did, value historically, if you look at any value fund, they're going to have a negative exposure to momentum if they don't screen for it at all,
Mm.
because that's how you get to be valued. So you have a negative, right? Right. And so the problem is what that was, so not the problem. When DFA did that, instead of having, let's say, a minus zero point 0.1 exposure to momentum, it went to like 0 or plus 0.05. So a very small amount of positive exposure. And that, if you think there's a momentum premium, for argument's sake, let's say you think it's 4%, well, a zero point 0.1 exposure gives you 40 basis points a year.
Mm. And why would they base it upon when the falling momentum stops versus when the falling momentum stops and rising momentum returns?
Well, as soon as the momentum stops being negative, they say it's not a factor anymore. So that would become eligible to buy.
Okay. And I think that how would you summarize the key lesson from this as a individual or as a professional as you think about, how I'm allocating? What is the key lesson from this chapter from your perspective?
Well, first of all, rule number one is follow the empirical research. The empirical research says that past performance tells you nothing virtually about future performance. The best predictor of future performance are factor loadings and the expense ratio. So those are the two things you want to be looking at. And then you could add in turnover, obviously, as well.
Hmm.
Those are the three things that you should look at, the construction rules used to create the fund, and then do they do patient trading to slow down the turnover and not pay away, liquidity premiums there. You don't want to be a liquidity taker. That means you're taking the offer price and hitting the bid. You want to be on the other side where when you have to sell, DFA doesn't go in and hit a bid. They'll put an offer in, maybe in between the bid and the offer, and they hope it gets taken. And if it doesn't, they've got 100 stocks they're doing that for. And they don't care which one gets taken. They don't know which one will do better or not. So they use these algorithmic trading programs, and that cuts down trading costs.
And the last thing before we end, I want to highlight a little bonus here. The article that you wrote about artificial intelligence and the risk of harking.
Yeah.
Um, could you just tell us the general conclusion you got from that? Like, what were you, was it what you expected. And I'm curious, like, what your thoughts are about
Yeah,
AI, because
here's
there's
the
some people that think, oh, now that we got AI, I mean, I just code something and then I outperform.
right. Well, here's we've always known there's a problem with data mining. And soon as you got big computers and much better databases, the problem became massive. Because when I was in college and studying, Markowitz and portfolio theory, if you had a theory, first you had to have a theory. Then you would take your punch cards, believe it or not, to the data center, hand them in, and pray you coded it right. Because if you made one error, it threw everything off. And then maybe 3 days later, because it was so expensive to run, you'd get your data back and hope it was right. So you couldn't test like 50 different theories, right? You ought to have some logical reason to believe that this correlation existed because there was causation there. Okay. Once you got big data, you could run all kinds of data mining, like a famous experiment on the United Nations Economic Database. And they found that the best predictor of the S&P 500 was butter production in Bangladesh. Now that's torturing the data until it confesses. It has no meaning, right? Because there is no causation there. So now with artificial intelligence, what you have is the ability to use these large language models and much more massive databases you could not have used before because the computers weren't fast enough and you didn't have the large language model capability. So you could tell the computer to go find something and it will deliver. But you have no idea about two things. Number one, is there any logical reason to believe that correlation will persist in the future? Is there some hypothesis that was created before the fact, not after the fact? Okay, I can figure, right? But here's the other thing that most people aren't aware of. You have to know how you train the model because you could have this look ahead bias. You're training it on the data that includes the data you're training it on. So what you should do is, let's say you're looking at the period 1929 through 2024. You should train it maybe on the data from 1929 to 2000. That's your in sample. See if, and then run it on the out of sample post 2000. So you don't know unless they specifically tell you how they trained the model. That's another risk. So you can get this stuff without any hypothesis. That's the problem. It's really a dangerous thing. And in the paper I wrote there, these are top level economists, they trained a large language model to look at like 200 factors and write peer-reviewed academic paper qualities on all these factors. And it would cite the citations. And sometimes, by the way, it stated phony stuff. It's amazing. They're not always accurate. So it can be a real problem.
So if a young person comes to you and they say, why do I have to learn all this stuff? AI is going to produce performance for me in the future, and I can be a hedge fund manager, and I've got a better AI model than the other guy, and therefore AI is going to replace fund managers, and these models are, going to deliver. How would you say? Would you say
Now,
yeah?
I would say from everything that I've read that AI is a tremendously powerful tool that only works well when you have human beings overseeing, understanding the processes, the construction of the models, how it builds portfolios. And all of the research that I've read so far has said that if you run just AA models and look at performance, or you run it combining AA models with human intelligence, the human intelligence with the models does better than either human intelligence alone or the models alone. And
So I
it's
can
for the reasons
outperform.
I think I've highlighted.
So I can outperform now.
You may be able to outperform if you can figure it out before everybody else. That's the problem. because everybody, once you discover something, it's not like Renaissance Technology is the only firm out there doing it. You got all these other big hedge funds and Apollo and AQR. They're spending, tens of millions of dollars, if not more, to try to figure this out. And, once somebody figures it out, they maybe leave and start their own fund and replicate. So the advantages are going to tend to be very short lasting, in my opinion. You'll have to keep outrunning it to gain any real advantage. But I doesn't mean it won't disappear. We've seen
Yep.
the hedge funds like Renaissance do well for you. But here's another indication of the capacity problem. You read almost every month now, some big hedge fund that was highly successful is returning billions, if not tens of billions, to investors so they can manage only their own money now because they can't manage more than that because the capacity won't allow for it. And I
Mm.
think that's a result of the problem we've just discussed.
Yeah. And it reminds me of the book Future Hype, which was all about teaching us that advancements, are so like if I think about how long it took for people to catch on to what, let's say, uh, what's the medallion fund, the one you just mentioned, the Simmons guy,
Yeah, Renaissance
yeah,
technology.
Renaissance. Sorry. So it took the world many years to catch on what Ray Dalio and Renaissance and these guys were doing. But nowadays, if AI's now my AI is going to compete with your AI, and all
Yeah.
of a sudden the gap of time for inefficiencies to survive could possibly just get tiny and shorter and shorter and shorter.
And a lot of it could even be legislated away. I don't know why the SEC, for example, doesn't put a stop to the high frequency traders by forcing them to stop these ghost bids. So, in other words, it should force them to say, if you put in a bid or an offer, it must be outstanding for 2 seconds. But they ghost them and they put and trying to outfox everybody else. And so you see phony bids and it tries to be misleading. But they could put a stop to all of that immediately.
Mm.
And that would cause a lot of their profits even to disappear.
Well, the other thing which we see in the space of startups, particularly here in Asia, is that for years it was free money. Any startup could get funding, and all of a sudden, and the same thing with AI models and all the funding they're getting and all that. But at some point, I gave a speech last week where I talked about how a typical AI search is 10 times more energy consuming than a
Yeah.
Google search, and at some point, that's going to come. That price is going to
10
come home.
times or is it 100 times?
The number I saw was 10
It
times, but
may
it could
be.
be.
I thought I read that it's even bigger than that.
Yeah, my study that I had looked at may have been, limited, but I wouldn't doubt it if it's 100 times. But let's just say it's massively more energy intensive than a Google search, as an
And by
example.
the way, we're short of energy capacity, certainly in the United States. We're setting records now. I mean, we may not have enough heat or electricity for Texas and Florida because of a cold snap there. And imagine when you're adding, I mean, Amazon alone is spending 80 billion in the next year to build data centers. Where's the power going to come from? And where's the water going to come from? We're short water to cool all of these computers. We're short water. And they're
Well,
building these things in the desert where land is cheap, but there's no water.
huh. Maybe it would make sense to buy a big piece of land in the northern hemisphere that's really cold and surrounded by water.
Yeah, maybe.
That one last thing I was just going to say
Maybe
is,
that's called Greenland. Maybe that's why Trump's
huh,
trying to take
huh.
over Greenland.
Yeah, that's where all our data centers go. I want to go back to 1967. I was 2 years old. My father graduated in his PhD in organic chemistry in 1965, and a movie came out in 1967 called The Graduate. And in
Yeah.
that movie, the young man was getting
Last,
advice. Yeah, and he got
last,
advice, and he said, "What's the future?" And he said, "Plastics."
yes.
And my dad was going to work for DuPont, and he sold plastics his whole career, and he rode that wave. And now, ladies and gentlemen, if you're listening in, the future is power.
Yeah.
And on that, I want to thank you, Larry, for this great discussion. And I look forward to our next chapter. And that is chapter 25. Battles are won before they are fought, which is going to be a fun one because we're going to talk about Sun Tzu and the art of war where we kick off. So I'm looking forward to that one. And for listeners out there who want to keep up with all Larry's doing, including that piece that he did on AI and all of that, just follow him on X, on Twitter, at Larry Swedroe. And also you can find him posting those things on LinkedIn. This is your worst podcast host, Andrew Stotz, saying, ladies and gentlemen, I will see you on the upside.